Welcome to Taking Stock with Lisa Brown. My special guest today is LaTanya Simmons. She's a vice president and private risk advisor with Aon. LaTanya helps highly successful individuals protect their affluent lifestyles through insurance. And she also does a tremendous job educating people about what those risks are that could really disrupt their lifestyles. And one of LaTanya's recent posts really attracted my attention, in particular, as I have a lot of clients who are working professionals who also own a vacation home. And the last thing that they need to deal with is their home insurance company suddenly going out of business. So I've invited LaTanya to join us today to talk about some of the perils of owning a vacation home and, importantly, how to protect yourself. Welcome, LaTanya.
Hi, Lisa. It's great to be here, and thanks so much for having me.
Absolutely. So, LaTanya, the first thing I would love for you to share some insights with our audience on is about the article that you put out there that came across my inbox about an insurance company in Florida going under. I know if I were insured with that company, that type of message would cause absolute panic to set in when I read it. So tell us what's going on in Florida, and if someone is impacted with their insurance company going out of business, what should they do next?
Well, Lisa, over the last few years, the insurance climate in Florida has become increasingly challenging. So, unfortunately, it has now reached a state of crisis, which was what the article was about. And it's due to a combination of factors. Back in 2020 alone, carriers had spent $1 billion in losses, primarily caused by hurricanes and wind events. Also, Florida is a highly litigious environment, and the cost of litigation and the frequent involvement of independent adjusters has just driven up the cost to resolve claims. So the result has been carriers operating at a deficit, and their response has been to either limit their capacity or decide to ultimately just leave the state. So if you find that you are insured by one of the carriers that no longer offers coverage in Florida, we recommend that you explore options with other carriers immediately. A first line of defense is to check with an independent agent or broker, as they represent more than one carrier and can do some of the legwork for you to locate alternatives. If after doing that, you find that there are just a few choices, then the other option is to consider Citizens, which is Florida's state-run insurance facility. It is usually a less expensive option than private insurance carriers, but something to note is that their policies are typically not as broad and do have a maximum coverage limit of $1 million. So just some things to think about if you do find yourself in that position.
And I know certainly with the real estate market these days, having $1 million home on the beach seems almost kind of the minimal price point out there. So making sure you have enough coverage to ensure things like the cost to rebuild and keeping up with current values, I think that makes a lot of sense.
No, agreed.
A lot of my clients do love to vacation at the beach, and some have a home there now, or part of their retirement plan is they say, we want to retire to the beach one day. So when it comes to protecting your beach home, what should people be thinking about that they often tend to overlook?
I think usually people go out and try to find the house of their dreams first. But my suggestion is once you begin thinking about buying in Florida, the best first step is to reach out to your agent to explore insurance availability in a particular city or county. So in the ones particularly like Miami-Dade or other ones that are right on the coast, it can be very challenging to secure insurance. Many carriers even have a total account premium minimum that includes the property, auto, collections, and umbrella policies. Or they might even require that there be another property in the account that's not in a catastrophe-prone area in order to offset the risk. So it's best to find that out on the front end rather than after you found your dream house and have your heart set on it. So often we found that the insurance can be more expensive than the annual mortgage payment, which can drastically impact the overall buying decision.
And it sounds like it could impact where you want to buy. So, maybe the Carolinas, for example, have a little bit more favorable insurance coverages available. So, you don't really think about insurance being the driving factor behind what sort of home you want to retire to. But to your point, the insurance can be very, very expensive and impact somebody's retirement budget, which is, I think of as a financial advisor, that unknown expense can put a big wrinkle in someone's retirement plan if you're not thinking about that advance. So I think that's a really, really strong point.
Yep, agreed. And all coasts aren't created equally. So certainly the Georgia coast may be viewed differently than the coast of Florida or even the Gulf Coast. So we can still get you to the beach. Let's just help you figure out which beach it is.
Great point. Great. So one of the other issues when I think about insurance and kind of changing market conditions is how often somebody should be reviewing their insurance policies. And they often think about, what's going on in my situation, my financial situation, my properties. But how often should somebody be thinking about the health of their insurer as part of their overall review of their coverage?
I think we definitely encourage loyalty and think that there's value in relationship longevity. However, carriers periodically introduce new coverages, enhancements, or new pricing. So we generally recommend reviewing property and casualty risk management programs every 3 to 5 years. Also, in terms of your agent or broker, you need to consider what their standards of due diligence are. So, for instance, with Aon, we refuse to do business with any company that has below an A rating, which ensures their financial strength. But every broker and agent isn't the same in terms of that. So, finding out about the carriers themselves, as well as the broker and their standards, is equally as important. So, in terms of you looking at your program every 3 to 5 years, not only does this allow you to capitalize on any innovations in the market, but it also ensures that the current program addresses your current lifestyle. So, for instance, maybe 3 years ago, you didn't have a young driver, and now you do. Or maybe you've developed an extensive wine collection over the last 5 years that should now be accounted for. So, the bottom line is things change over time, and you want to make sure that your program evolves along with you.
Thinking about how things change over time, I think about the careers that my clients have or have had. And the longer they're working in corporate America, typically the bigger job they're having, the higher profile corporate job they tend to have. Some of my clients are in the spotlight often. They're in the news, they're on social media, the front page of their company website. What sort of risks do higher profile people need to also be thinking about when it comes to their insurance?
Yeah, I mean, I think the truth of the matter is that we live in the information age. With multiple social media platforms, it's very easy to find out a wide variety of information on anyone without even really trying. So, as a higher profile or a highly successful individual who may often appear on the websites or in local papers or even serve on nonprofit boards, our goal is to assist in not having your lifestyle expose your wealth to risk. Successful individuals and families would really do well to consider their risk using a wide lens. So this includes both their primary property and secondary home coverage, but also the auto, collectibles, such as jewelry, fine art and wine, aviation, and watercraft. And I think the most often overlooked coverage, especially in talking with wealth advisors, is the umbrella. And this is the primary method that we use to protect the wealth that it could have taken years or even generations to accumulate. So often we see families who are completely or even partially unprotected in the event of a catastrophic event that leads to a lawsuit. So generally, we recommend that the umbrella limit match your net worth amount. So that way, should you find yourself involved in a lawsuit, the insurance is the first to pay rather than you having to liquidate any investments to satisfy judgments. So if a client or family has additional risk factors, such as they own jet skis or they have young drivers or they're on a board, then we'll usually recommend a multiple of that net worth as a limit. That we believe that wealth preservation is equally as important as wealth creation, and that you need to make sure that you're doing and taking the steps to protect all of it.
Absolutely. Risk management is such an important part of the equation, as not only are you building your wealth, but when you're at a point where you're done building it and you're in retirement and you're trying to preserve that risks don't go away. They just change and evolve over time. And especially with your point about the umbrella policy matching the net worth, I think about the stock market the last 3 years and the tremendous gains we've had. As much as people like to see their investment accounts do well, they may not be relating that to the fact that their umbrella policy is outdated. It's way too low based on their net worth. So the 3 to 5 year review, I would couple that with, it could even be an annual review, depending on what's on your balance sheet and how volatile your balance sheet could be, either up or down. I certainly can't think of many instances where we'd want somebody to lower their umbrella policy, but perhaps you have like a lot of company stock and it just balloons one year and now you're worth millions of dollars more than you were the year before. So I think that's really important advice, the 3 to 5 years, but even sooner, depending on, the nature of your balance sheet.
No, absolutely.
So we've covered a lot today, a lot talking about the insurance market with vacation homes, but other risks for higher profile clients. Is there anything else that we should be thinking about, LaTanya, when it comes to managing the risks around our home or autos or any other property?
Sure. I'd like to encourage listeners to include risk management as a part of their overall and ongoing wealth strategy. Many families, as you mentioned, have their wealth grow over time, and they often decide to upgrade their wealth advisor and their CPA, or they begin to create, complex tax strategies like LLCs and trusts. But risk is usually not that conversation that readily comes to mind or is considered, especially for, busy working professionals like your clients. Having a close relationship with your private risk advisor where you have annual renewal discussions, so that we can be proactive and make sure that things happen and change real time, is important, because risk advisors can not only right size your program, but they can give you the tools to make educated decisions and be proactive in the management of your wealth. So we work together as a team, not just with the client, but also with the other advisors, sitting at the table in your wealth management team.
Right. It is a team approach. That's really, really important. Well, LaTanya, I'd like to thank you so much for joining me today and sharing your wisdom and experience as a risk advisor to educate us on the risks of only owning a vacation home for sure, but the other risks that higher profile people face. For our listeners who would like more information about Aon and LaTanya's services, you can contact her at 404-264-3112 or email at latanya.simmons@aon.com. Thank you so much and be well.